Do not trust here. So maximizing your Fidelity 401k return involves a combination of contribution strategies, smart investment choices, and ongoing management, right? So in this video, I'm going to cover that precisely. However, before I proceed, take a moment right now to hit that subscribe button and that like button. I appreciate you. So first, let's start off with maximizing contributions, right? Especially the employer match. Now, here are the key steps to maximize your Fidelity 401k contributions. Number one, contribute early and consistently, right? Start contributing as soon as possible to take advantage of the compound growth over time. The earlier you begin, the more your investments can potentially grow. Aim for the IRS maximum. For 2025, the employee salary deferral limit is $23,000 if you are under the age of 50 and $30,500 if age 50 or older, including catch-up contributions. So consider using tools like the contribution maximizer to calculate the precise percentage or dollar amount needed from each paycheck to reach the annual limit. Take full advantage of employer match, right? Always contribute at the least enough to get the full employer match, as this is essentially free money for your retirement. For example, if your employer matches, 50% up to 6% of your salary, contribute at least 6%. Work toward a 15% retirement savings rate, right? Fidelity recommends saving at least 15% of your income annually for retirement, including both your contributions and any employer match. Automate increases. Use Fidelity's annual increase program to automatically raise your contribution percentage each year, such as increasing by 1% annually until you reach your target rate. The set and forget approach helps you gradually maximize your savings without feeling the impact all at once. Maximize your bonuses and windfalls, right? Consider directing a portion of any bonuses or unexpected income toward your 401k to boost your annual contributions. Monitor your vesting schedules. Be aware of your employer's vesting policy to ensure you retain the full value of matched contributions, especially if you're considering changing jobs, right? Keep track of old 401ks, so consolidate or roll over old 401k accounts to avoid losing track of your retirement savings and to simplify management. You're going to also want to choose the right investments. So in regards to diversification, spread your investments across different asset classes like stocks, bonds, and international funds, as an example, to balance risk and reward. You're going to want to target date funds. If you prefer a hands-off approach, target date funds automatically adjust your asset allocation as you approach, retirement. These are often the default option and can be a solid choice for most savers. There's the 3-fund portfolio approach as well. For more control, consider building a 3-fund portfolio using low-cost index funds for U.S. stocks, international stock bonds. This approach is simple, diversified, and cost-effective. There's low fees, so prioritize funds with low expense ratios, ideally below 0.1%. High fees can significantly erode your returns over time. Now, that's the gist of it in a sense, right? But, okay, we have the Fidelity, 401k, but what to invest in? I did some research, and here are reportedly the best investments for your Fidelity 401k, depending on your risk, your tolerance, time horizon, and retirement goals. Okay, now these funds that I'm about to discuss are basically, they're widely recommended because of their strong long-term performance, their diversification, and low fees. Number one, we're going to talk about core index funds like the Fidelity 500 Index Fund, which tracks the S&P 500, providing broad exposure to large cap US companies with a very low expense ratio of 0.015%. This is a core holding for long-term growth and stability. There's the Fidelity Total Market Index Fund, which offers exposure to the entire US stock market, including large, mid, and small cap, companies. It's highly diversified and suitable for a set it and forget it approach. There's the Fidelity US Bond Index Fund, which provides broad exposure to US investment grade bonds, offering stability and income, which is important as you approach retirement. Now here are the actively managed funds, right? There's the Fidelity Contra Fund, which focuses on large cap US stocks and has a long track record of outperforming the market through active management. There's the Fidelity Blue Chip Growth Fund, which invests in established high growth companies, primarily in the technology sector. It has delivered strong long-term returns, but comes with higher volatility. There's the Fidelity Growth Discovery Fund, which targets companies with above average growth potential and has performed well in various market conditions. There's the International Diversification, basically in that umbrella, there's the Fidelity Total International Index Fund, which offers exposure to developed and emerging markets outside the US, helping diversify your portfolio on a global scale. In regards to low risk and conservative options, there's the Fidelity Balanced Fund, which combines stocks and bonds for a mix of growth and stability, which is suitable for more conservative investors and those nearing retirement. There are bonds and money market funds, which is basically for those prioritizing capital preservation. Fidelity offers various bond, mutual funds, and money market funds that focus on short-term, high-quality assets. You have to also monitor and rebalance, right? Review your portfolio at least annually if your asset allocation has drifted. For example, if stocks have grown much faster than bonds, rebalance by shifting funds to maintain your desired mix. Avoid frequent trading or trying to time the market, so staying invested and maintaining your strategy generally yields better long-term results. Avoid concentration in company stock, so limit company stock to no more than 10% of your portfolio to reduce risk from lack of diversification. Now, it's all good. We know about Fidelity investing, 401k, all of that. We talked about some potential investments to invest in. However, there are some types of investments to not over concentrate yourself in, okay? And case in point, I'm going to discuss right now are like a company stock, right? So avoid putting a large portion of your 401k, your Fidelity 401k, in your employer's stock. This is a common mistake that can significantly increase your risk as financial future becomes tied to your employer's performance. Many experts recommend limiting company stock to no more than 10% of your total retirement portfolio. There's these single asset classes to not overextend yourself or concentrate yourself, right? And this goes for all stocks, the single asset classes. So while stocks offer growth potential, holding too much in equities, especially a single sector or region, can lead to higher volatility. So consider balancing with, bonds or other asset classes, especially as you approach retirement. Also, high fee, actively managed funds. So over concentration in funds with high management fees can erode your returns over time. So index funds typically offer lower fees and broad market exposure, making them a better choice for core holdings. There's sector specific or, thematic funds. Avoid putting, too much into sector funds like technology or healthcare, or thematic investments such as ESG or emerging markets. These can be more volatile and less diversified than broad market funds. You want to also plan beyond your 401k, right? Your Fidelity 401k. And the steps to do that is to max out your 401k contributions. So first, ensure you are contributing enough to your 401k to receive the full employer match, as this is essentially free money. For 2025, the individual, we talked about that, that's $23,500 with additional catch-up contributions if you are 50 plus in regards to age. Some plans allow, after-tax contributions beyond these standard limits up to a combined employer and employee limit, which is around $70,000 in 2025 for some plans, okay? Open and fund the IRA. So consider, contributing to an individual retirement account. You can contribute to a traditional IRA, Roth IRA, or both, as long as your total contributions do not exceed the IRS limit of $7K in 2024 and, basically $8K if you're, 50 and plus. IRAs offer tax advantages and can be used in addition to your 401k. Use a health savings account as well, or consider it. So if you have a high deductible health plan, and basically an HSA offers triple tax benefits, basically tax deductible contributions, tax deferred growth, and tax-free withdrawals for qualified medical expenses. After age 65, you can use HSA funds for non-medical expenses without penalty, though regular income taxes apply. Consider after-tax 401k contributions as well. So if your plan allows, you can make after-tax contributions to your 401k beyond the pre-tax or Roth limits. This strategy, can be paired with a mega backdoor Roth, basically a conversion for additional tax advantage savings. Invest in a taxable brokerage account. So once you've maxed your tax advantage accounts, you can invest additional savings in your regular brokerage accounts. So while you won't get to the same tax benefits, these accounts offer flexibility and no contribution limits. You can invest in stocks, bonds, mutual funds, ETFs, and more. Also explore other employer benefits. So if your employer offers stock options or non-qualified deferred compensation plans, these can also help boost your retirement savings. Consider Roth conversions, right? So if most of your savings are in a traditional pre-tax accounts, converting some funds to a Roth IRA or a Roth 401K can provide tax-free withdrawals in retirement, offering more flexibility in managing your tax bill later. Also, diversify and rebalance investments, right? Ensure your investments are diversified and periodically rebalance, right? Your portfolio to maintain your desired risk level. Save enough. Can't say that enough. Aim to save at least 15% of your pre-tax income for retirement, including employer contributions, okay? So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you appreciate this content and you want more like it, let me know that by hitting that subscribe button and the like button. Also, let me know your opinions in the comment section below. I appreciate your viewership. Stay safe and see you on the next video.